Balance sheets and income statements, they all start with the general ledger. So what exactly is the general ledger? It's a system of accounts that allows the accountant to quickly see all the activity for any account in one place. Want to see all the bank activity that was recorded? There's a general ledger account for each of the business's bank accounts. Want to see all the activity related to office supplies? There is an account for that too. When I first started working in accounting, companies still used physical ledger cards like the ones shown here. Today, accounting software maintains these records electronically, but the idea is the same. The general ledger is the permanent record of all account activity within the company. So how does the accountant use the general ledger? First, the accountant analyzes the business transaction with the help of the accounting equation or a T account. Second, the accountant records the transaction in the general journal. Finally, the accountant transfers the general journal entry to the general ledger with a process called posting. During the posting process, each line from the general journal is transferred to the accounts listed in the journal entry. Notice that our journal entry affects two different general ledger accounts, equipment and cash. Let's practice this concept with the help of an example. On January 2nd, Company A purchased equipment for $2,000 with cash. When we analyze this transaction, we determined that equipment increases, so we debit equipment for $2,000. Cash decreases, so we credit cash for $2,000. Next, we recorded the transaction in the general journal. And now we're ready to post the journal entry to the general ledger. We start with the equipment account. We enter the date of January 2nd, the journal ID of J1, and the debit amount of $2,000. The new balance in equipment is now $2,000. Next, we move to the cash account. The cash account already has a beginning balance of $8,000. We enter the date, the journal ID, and the credit amount of $2,000. And the new balance in cash is now $6,000. The final step is to return to the general journal and indicate that the entry has been posted. This notation tells future accountants that all of the lines from the general journal entry have been already transferred to the general ledger. This completes the posting process. And in modern accounting systems, this happens automatically behind the scenes. What you're learning here is the manual process so that you understand what the accounting software is actually doing for you. One journal entry always affects at least two, but often more accounts in the general ledger. In our example, one transaction updated both the equipment and the cash account. And when we look at the individual general ledger accounts, we quickly realize that the general ledger organizes transactions by account instead of by date. The general journal answers the question, what happened today? The general ledger answers the question, what happened to this account over time? Both records are important and work together. The general ledger brings everything together. It provides a complete, organized, and permanent record of every business transaction. Because all activity is organized by account, accountants can quickly review balances, investigate unusual transactions, and prepare financial statements. Whether the information is stored on manual ledger cards like these or inside modern accounting software, the purpose of the general ledger remains exactly the same: to provide one complete history for every account in the business.